There's a dangerous new financial trap spreading across the world, and it's designed to look like a helping hand. It's called the 50-year mortgage. Banks and lenders are quietly pushing this as a way to get lower monthly payments. But what they do and tell you is that it could lock you into debt for the rest of your life, maybe even pass that debt on to your children. Today we're going to expose this trap. We'll show you exactly how it works, why banks are so eager to sell it, and the hidden dangers most people completely miss. We'll run the real numbers to show you just how much you stand to lose. And most importantly, we'll figure out who actually benefits from these ultra-long loans and whether you should ever consider getting one. Let's break it all down before you sign away half a century of your financial freedom. First things first, what exactly is a 50-year mortgage? It's exactly what it sounds like, a home loan stretched out over half a lifetime. You're probably familiar with traditional mortgages like a 15-year or the very common 30-year loan. But now, in an effort to make expensive homes seem more affordable, banks are offering 40 and even 50-year home loans. Their big selling point: they claim it reduces the monthly burden. And yes, on the surface, the monthly payment is smaller. But here's said the brutal truth: you end up paying 2 to 3 times more in interest over the life of the loan. Let me say that again. A 50-year mortgage gives banks decades more time to charge you interest. It's not cheaper, it just feels cheaper month to month. So why are banks so keen on pushing these loans? Let's be clear. Banks don't do anything for the people. Every decision they make is based on profit. And 50-year mortgages are a goldmine for them. The first reason is the most obvious. You pay interest for far longer. Extending a loan from 30 to 50 years gives the bank an extra 20 years of pure interest payments from you. 20 years. Secondly, it makes wildly expensive houses appear affordable. When home prices are skyrocketing, most people can't qualify for a traditional loan. So banks stretch the loan term, which lowers the monthly payment just enough to get you approved, but the total price you pay becomes absolutely massive. The third reason is what they call higher lifetime customer value. A 50-year mortgage often means you'll be back for refinancing, paying more fees, buying their insurance products, and using other bank services. It turns you into a long-term profit machine. And finally, the most sinister reason: it normalizes lifelong debt. The goal is simple: keep you borrowing for your entire life, and even create a system where financial dependency is passed down from parents to children. This all works because of a powerful psychological trap. People are naturally wired to focus on the monthly payment. If a bank presents two options, pay $1,900 a month for 30 years, or pay just $1,400 a month for 50 years. Most people will instinctively choose the cheaper monthly payment. They don't stop to calculate that this cheaper option could cost them hundreds of thousands of dollars more in the long run. Another part of the trap is that we humans are terrible at understanding long-term consequences. 50 years feels like an abstract concept. We think about next month's bills, next year's vacation, the next paycheck. We don't really process what being in debt for 5 decades truly means. Finally, these loans are presented as the only option. When rent is high and home prices are out of control, people feel desperate. They step in with these loan products that look like a lifeline, but are actually designed to take advantage of that financial desperation. Let's look at a real-world example to see just how much you actually lose. Beyond the staggering interest, there are other hidden risks you need to be aware of. First, you build equity incredibly slowly. With a 50-year mortgage, the first 15 or even 20 years of your payments are almost entirely interest. You're barely paying down the actual loan on the house. This means you have very little ownership stake in your home for a very long time. Second, you might still owe a huge amount of money even after decades of payments. It's not uncommon for people to reach retirement age and discover they still owe 60, 70, or even 80% of their original loan. Third, you're trapped if your income drops or you need to move. Because you have so little equity, selling the home can be difficult, and refinancing becomes much harder. You're also paying more in property taxes over the decades, simply because you're on the hook for the property for a longer period. So, who does a 50-year mortgage actually help? Let me be perfectly clear. It helps banks and lenders. Full stop. It does not help middle-class families trying to build wealth. It does not help the younger generation get a strong start in life. It certainly doesn't help retirees enjoy a debt-free retirement. It only helps financial institutions maximize the interest income they can extract from you over the longest possible time. Now you might be wondering, is there ever a situation where a 50-year mortgage could make sense? There are a few very rare and specific scenarios. For example, if you know for a fact that you plan to sell the home in just a few years, say under 7, and you just need the lowest possible monthly payment temporarily. Or if you're a highly disciplined investor who will take the monthly savings and invest it in something that earns a higher return than your mortgage rate. This is a very risky strategy that requires a lot of financial expertise. The other rare case is for people who have a clear and certain path to significant income growth in the near future, like doctors finishing their residency or entrepreneurs about to launch a proven product. They might take the loan with a plan to aggressively pay it down or refinance as soon as their income jumps. But for 95% of people, this is simply not a smart financial move. So what should you do instead? There are much better options. First, stick to a traditional 30-year mortgage if you can. It's safe, it's predictable, and it allows you to build equity at a reasonable pace. Second, focus on refinancing when interest rates drop. This can lower your monthly payment without adding decades to your loan term. Third, try to make 1 or 2 extra mortgage payments per year. This simple trick can shave years off your loan and save you tens of thousands of dollars in interest. Fourth, consider buying a smaller, more affordable home. A modest home that you truly own is infinitely better than a big, fancy home that owns you. And finally, work on improving your credit score before you apply for a loan. A better score gets you a better interest rate, which will save you far more money than any extended loan term ever could. The final warning I want to leave you with is this. The 50-year mortgage is a psychological trap. It's dressed up to look like help, but it's really a golden cage. You get slightly lower monthly payments, but in exchange, you get a much higher lifetime cost. Decades of paying pure interest and a lifelong dependency on lenders. It's a trap designed to make the bank rich while keeping you on a treadmill of debt forever. So be smart. Always run the numbers for yourself. Think long-term, not just about next month's payment. A 50-year mortgage might look attractive today, but when you see the total cost, the truth becomes crystal clear. It's not a home loan. It's a lifetime subscription to debt. Stay informed, stay smart, and protect your financial future. Thanks for watching.